how to monitor the trade. And fortunately, I've got a good example here from the trade, the hypothetical trade that took place in the previous video. Now, if you remember, we actually couldn't enter this trade because the stop loss was too large. But nevertheless, let's use this one as an example. Now, a lot of this monitoring trades I'm going to have to do through our live trading sessions and through the webinars, because a lot of what I look for is, first of all, the target, and this one actually hit the target of 40 to 50 pips on the way up. Now, you've got to give it a little bit of room, and there's lots of different ways of doing this, and it depends on what you're aiming for overall as well. But this one moved up quite rapidly, fiddled around for a bit, and then moved up to our target. But look what happened at around this level here, at around 29.60. Let's say our target was much higher, and again, this is a hypothetical example because the moves here are very large and we actually wouldn't be in this trade anyway. But look what happened here. We had a spike high and a bearish candle, followed by another spike high and a bearish candle. Now I'm going to try and actually highlight those on the screen, so let me just get my writing pad into place. And okay, that's not going to work. Just got to find this drawing tool. Right, so this candle here formed a little spike high there, then it moved down, and that was almost a bearish engulfing candle. But if we were still in, we formed a second spike high there and another bearish engulfing candle. Now, this is a sign for us to get out of the trade, and you can see we've kind of broken down through that level, and now we're heading lower. Now, if we hadn't hit our target, I'd be looking at the price action. Now, it also depends on how much you want out of the trade and how much you have perhaps for the week or for the month in the kitty already, whether you're taking your second trade or third trade of the day. Normally, I would only take one trade if it's a very good profitable trade. It would also depend on whether you perhaps had some losses earlier in the day and you were trying to recover them. But the idea here is to watch for price action. And okay, that was a mistake. And this is quite a difficult part of the trading process. I'm going to try and go back to another example. And I'm not going to make this video too long because a lot of this will need to be explained. Now, here's an example during the Asian session where we had a trade entry over here, and I want to show you again an example of price action. Let's just put the screen draw on there. This is a rather obvious one, but there we got into the trade there. The price starts moving up, and then bang, it moves down and takes out our stop loss at break even. Now, I'm going to talk about moving stops to break even in a minute. Now, the reason that trade was an obvious exit was because of this big bearish candle, and a lot of this is going to have to be, unfortunately, learned intuitively as we go along. I'm going to try and get another example, and that's why these live sessions are so important. Here's an example of a big bearish candle which caused the price to move down. I'm going to try and find a good example here. Unfortunately, we've had a few choppy days on the euro. Let me just find one. I'm going to pause this. Alright, here's a reasonable example which illustrates a couple of things, in fact, on the dollar yen. And first of all, we have this move up, this very steep move up here, and I've compressed it a bit so you can see we've got a trend line here which starts at around 10 a.m. and ends at about 11:30, so it's only an hour and a half, but look how steep it is as well. So even though we have an overbought stochastic, we're right the way through the Bollinger Band. As you can see, there is no valid trade entry signal there. So we wait for a bit longer, and I'm now able to draw a trend line across here, or I could draw one in that sort of direction, or like that. But you can see drawing it up here, there's no smooth trend line, whereas drawing it along here is a beautiful smooth trend line. So this is the place to enter the trade. Alright, sorry, I just keep on getting interrupted by the same phone call, which is important. So we have this beautiful trend line, and again we have the Bollinger Bands almost touching each other right there. Well, not really a confluence, but getting closer, and then we have this move down. Now what I want to focus on is the exit of this trade, and you can see we were able to get into this trade at around about let me just redraw that trend line, it's not quite right. Okay, I'm just going to ignore that little spike. I think we've already looked at this one before. So the entry for the trade was right there, and that gives us an entry at about 93.35. Now I always allow the price to move at least 20 pips before I make any decisions whatsoever, and also at the 20 pip level I normally move the stops to break even, and as that's almost a 95% rule. So 93.35, we get down to 93.15, that's here. The stops would then be moved to break even, and you can see the price begins to move down. We get down to 93.90, that's already 45 pips. In fact, we get down to 85, having 93.85, having got in at 35. That's a 50 pip target on that trade already. And you can see all the way down from 15, there are no bullish candles. So once we get to 20 pips at 93.15, there are bearish candles all the way until we get to here at 92.90. And then look at this candle right here. This is a big bullish engulfing reversal candle. If I was still in the trade, which I wouldn't be, having taken 50 pips profit, I would immediately exit on that bearish candle at 93, let's say 93.10, and the entry was at 93.35, so that would give me a 25 pip profit. But having said all of that, we would have got out of that trade a little bit lower. Now this is all a little bit complicated to explain in terms of price action, but this is one of the things I want to highlight to you during live trading. But and a lot of this comes from experience, but what I do want to show you here is a couple of principles. First of all, allow the price to move to plus 20 pips before making any decisions. Now the decision you could make at that stage, if your stop loss was around 20 pips and you wanted to get out at a 1-to-1 risk-reward ratio, or if you were just looking for a quick profit for the day and you wanted to get out, so you could either take profit, not advised if you're taking a normal trade, but if, like I said, if it's the end of the day and you're looking for a quick profit, or you want to round off the week or the month, then you can take profit, and I'll often do that and just take a few pips. But in general, what we're really going to do is move stops to break even. I call it SBE, it's easy to write, so just as a note for you, SBE is equal to stops to break even, and that means I move the stops to my entry price. So if I got in, let's say I sold over here at 95, and we moved 20 pips down to 89.80, and that move is 20 pips there. Immediately I move my stops to the price that I got in at 90, and that means that I have no risk on the trade. So that's the first thing I'd normally do, allow the price to move at least 20 pips in our favor. Either take profit if you're looking for a quick profit, or at the very least move your stops to break even, and that means this trade is now protected, it's safe, there's no risk on the trade. And then I begin to monitor the trade and see how far towards, and let's just make some space here, and then I want to see, let's just recreate that to a certain extent. So we got plus 20 pips. Then we go to SBE or take profit. That means no risk on the trade. And then I want to see how far can I go. And ideal is plus 40 to 50, or the opposite Bollinger Band, or if there's a trend line below my entry, if I'm selling. In other words, let's say I'm going to try and do this schematically. Okay. So let's say I've got a trend line like that, and I'm trading, and I take the sell there, but from a longer distance away, perhaps there's a longer term trend line coming up. This would be a shallower trend line connecting a different set of data from here and maybe here. Now if there's a longer term trend line coming up, I'll aim at least for that trend line, and if that's 20 pips, I might take profit. But if it's lower down, let's say 30 or 40 pips, then I'll also take profit. If I see the price action around this trend line beginning to reverse, sometimes you just get a clean break through, and then I know that we're going to head down to the next support level or Bollinger Band or whatever. There's a lot of scribble on this page. I hope it makes sense to you. But sometimes if there's a trend line, a longer term trend line straight below the shorter term trend line that I sold off, then I'll wait to see what happens when we get there. Now that brings me on to another important point. If there is a situation where I'm selling the break here, but there's a longer term trend line which is less than, so in other words, the distance from there from the break where I took the entry, if that's less than 20 pips, all right, this distance between where I sell and where the longer term trend line comes up underneath it, if that's less than 20 pips, generally I won't take the trade. And what I'll do is I'll wait to see what happens around here, and maybe we get this situation where it bounces off there, comes back up again, and we get another entry later on. So these are all little principles that I'm sharing with you, and a lot of these come from experience, which I'll have to show you during live trading and some of the webinars that we run. But these are generally the principles of watching the trade. So let's try and just summarize that, because like I said, I don't want to go into too much detail on this. So monitoring the trade. The key things to look out for: number one, do nothing until plus 20. Then you can go SBE, stops to break even, to remove the risk, or you can take profit if you're looking for a quick profit. Or number three, you can watch out, I call it watch out below. Look for Bollinger Bands, the opposite side Bollinger Band, or the longer term trend line coming up beneath. So watch out below. And four, aim for 40 to 50 pips if possible. And number five, the principle is to watch price action. And you could get even more advanced on this and say watch it around the longer term trend line, or Fibonacci, levels or horizontal levels, etc., etc. Horizontal levels. Now, all of this stuff here, watching price action and watching out below and sort of from 3 downwards, becomes not a lot of it, but some of it gets based on experience. And as much as I'd love to teach you a purely mechanical method of trading, I don't believe that any of them really work, and there's always some reliance on experience. Now, the beauty of the E75 system is that all the way up to this step here, from the entry conditions, trendline break, all the conditions that you need to watch for entry, getting into the trade, evaluating the risk reward by making sure the stop loss isn't too large or staying out of the trade, and then once you're in the trade, doing nothing until plus 20, and then either taking profit or moving to stops to break even. All of that up to that stage there, on everything that we've spoken about on all the videos, is more or less objective. In other words, it's not subjective. It's not based on emotion or feeling or gut feel or even watching price action. None of that is subjective. The only part where it becomes based on experience is from this step 3, watching out below for Bollinger Bands, long-term trend lines, aiming for 40 or 50 pips if possible, watching the price action at the long-term trend line, horizontal Fibonacci levels, and so on and so forth. This part is based on experience, and everything that we've spoken about from videos 1 to 5 or wherever we are now, the rest of this is all pretty mechanical. And that's the beauty of the E75 system, is most of it until you get to this last part. And this is the last part which makes me want to keep on mentoring you, keep on training you, keep on trading live with you, and keep on doing webinars. And in other words, I want to pass on my experience in this area here on an ongoing basis so that you can get experienced and proficient at getting out of trades in the market. So that's what that's all about. Right, one other thing that I want to talk about in this section of the video is trailing stop losses. And I'm not a great fan of trailing stop losses in this method of trading. However, if I feel that there's a lot of momentum in the trade and there's a potential move of maybe more than 50 pips, or I'm heading towards 50 pips but I haven't quite got there, I can use a system of trailing stops. Now, there's a variety of ways of doing trailing stop losses, and let me just there's a couple of main ways of trailing stop loss. Now, trailing stop loss, for those of you, that's really bad writing. A trailing stop loss, for those of you who don't know, let me see if I can write this. A trailing stop, or you can say stop loss, is as the price moves in your favor. So for example, in this case it's moving down. A trailing stop loss is a matter of moving the stop loss lower and lower, bit by bit, as you see, as a certain methodology involved dictates to you. You move the stop loss lower and lower and lower until eventually the stop loss is locking in more and more profit. First of all, break even, and then a bit more profit, and then a bit more profit, and you keep on doing that until eventually the trade stops you out for a profit, and you've given the trade a chance to run as far as possible. Now, this can be a fairly sensible way of trading, and a lot of people employ it, and I have no reason to discard it. In fact, I do use it sometimes, but I have a particular method of using a trailing stop loss. I don't believe in purely picking a random number. I believe in using the fractals. Now, let me explain what that is. On this particular chart here, I'm assuming that we're short, and what I'm waiting for is a little pause in the price action, like we have there, like we have there, and like we have here. And actually the simplest way to draw this is by putting just a little horizontal line. So we've had a move down here, we've got a little horizontal line formed there, and then another move down, a little bit of a bounce, another horizontal line form there, in other words the highs of these candles, then we have another move down, a bit of a bounce, horizontal line form there at the highs of these candles, and every time we get this little pause and slight retracement in the price action, I'm able to move my stop loss down. So in this case we got in at well, let's say 90. We had a move down to 90.50. I'm just ignoring the rule of locking in or of taking profit at 40 or 50 pips in this case, just for the illustration purpose. So we moved down to 19.50. We had a bounce back up to 19.60, and then a move lower again. So I moved my stop loss, sorry, 90. I moved my stop loss to 90.60. Then we moved down. We have another little bounce up to about 90.50. So I moved my stop loss to 90.50. Another move down, a bit of a bounce and a move lower, and then we were able to move the stop loss to 90.40, and eventually that's where we get taken out as the price moves up through that level. So we've managed to lock in, by the time we get down here, we've managed to lock in plus 50 pips, and there are cases when this can just keep on going, and you could make even more than the 40 or 50 pip target. I'm going to see if I can find an example of that for you. Right, here's a pretty good example of a trade that was short on the dollar yen. The entry price was at about 91, and we moved down to about well, about 90.75. So that's about 25 pips. So we've gone beyond our break-even point, and luckily we just didn't quite get stopped up as we went back to break-even. And then the price moved lower, so I could move my stops, basically leave them at break-even at 91. Then we moved lower, another little bounce up to 90.90, so I moved my stop loss to 90.90, and then move lower, and a bit of a bounce up to there. I can move my stop loss to 90.55, and then we moved lower, and then eventually we got taken out at that stop loss. So that by the time we moved our stop loss to 90.55, we've locked in 45 pips. Now, it's not very often that in an intraday trade that we'll go more than 40 or 50 pips before the price begins to retrace and mess around. However, there are occasions where you get a massive price movement, and you could get an enormous profit out of the trade. So I'm not going to try and find them now, but in fact there is a good example here on the euro, which is now moving down sharply after our move up. So in this case we would have got our 40, 50 pips anyway, but it's now moving down. Remember I said to you on this one, just to highlight to you, that we had these two reversal candles. When I talked about price action on this video just a little while back, looking at this particular live trade, I said this was a good time to get out because of these two reversal patterns. In any case, it hit, I think, 50 pips, even 60. But now you can see how that really has created this move down. This is the sort of thing I'm talking about when you can gain a large number of pips by using a trailing stop loss. It's quite rare, but it can happen. And let's just this is a long trade I'm going to demonstrate to you right now, and you can see we've moved up from here at about 28.50. We moved up to this level, then we moved back down again, retracement to about 28.70. Moved all the way up there, little retracement down to 29.20, and move up again, a little retracement down to 29.50, and move up again, a little retracement back down to 29 over here, 29.70, and a move up, and then eventually get taken out. So we've moved from 28.50 to 29.70, and that's plus 120 pips, just by simply locking in at each one of these levels, locking in a trailing stop loss, and that's 120 pip trade off the bottom here. And again, this is just hypothetical. I'm just saying if there was an entry signal here, which I don't know if there was or not. So that's the way you can use a trailing stop loss. But again, let's just summarize this. I really want to focus on this in our webinars and live trading, but I'm just going to summarize this very quickly for you. And again, at the risk of repeating myself, first of all, we want to aim for 40 to 50 pips. We want to, at plus 20 pips, we want to go SBE, stops to break even, or TP. We want to watch out below. What do I mean by watch out below? I'm talking about longer term trend lines below the shorter term one that we're looking at, or Bollinger Bands, and you can even then extend that to fibs and horizontal lines, but that will come with experience and as we talk about that. What else was there? Or 4, I think I missed out one, but any trailing stop loss, and I like to base that on fractals. Now fractal is the little retracement before the price action continues. And as I said, all of this requires a bit of experience. So what's the bottom line here? Once I'm in a trade, I need to then watch it. I need to watch the trade until I exit. So there's no set and forget here. There's no setting a target of 40 pips and leaving it. Whenever I'm in a trade, I watch it closely and I try to maximize the profit by either aiming for my 40 or 50 pips, taking profit at plus 20, or moving stops to break even. Then otherwise I'll watch out below, keep an eye on the Bollinger Bands, the Fibonacci's, the horizontal lines. I might employ a trailing stop loss using fractals. That's the little retracements, and I just use a bit of experience to make sure I try and exit the trade at the optimal level to maximize my profits. Alright, so there's nothing really much else I want to say about this right now. I'm just going to have a quick look at my notes, and yeah, there's nothing else I really want to say about that except for what I've written on the screen there, and just to emphasize that everything up to the trade entry and moving stops to break even at plus 20 pips, and then or taking profit, all of that is basically very objective, and the only subjective part in the trading setup in the E75 system is once we've got to plus 20 pips and we've locked in our stops at break even, the only section of this whole trading system is what to do after we've got plus 20 pips. And then that's where watching the trade, monitoring the trade, using trailing stop losses, watching out below, all of that sort of thing that I've just spoken about, that's where all that comes into play. Alright, so that's that, and as I said, a lot of this will be covered in live trading and webinars, and this is probably the most difficult part for people to get to grips with, but I'm going to make sure you do. So until the next video, ciao.